What are your thoughts on the stimulus and kind of a lot of the monetary policy that's coming out right now in response to kind of market conditions at the moment?
There's areas and things I'm very opinionated on. Other things that fall somewhat in the middle. I think this is hard. It's hard because there's so much uncertainty. We outlined this. We did a piece called Investing in the Time of Corona, where we said, look, here's a bull case. And we said, governments around the world respond. Everyone's doing testing. Self-quarantine works. There's treatments developed. Hey, maybe the malaria medication works. A vaccine comes along. Coronavirus is never seen again, essentially, or it's reduced. Markets hit all-time highs by year end, right? Then you have the bear case, which is governments respond, but it's too late. The virus is everywhere. It goes exponential. People are despondent. Treatments don't work. A vaccine is 2 years away. The summer comes around, has some relief, and then the virus comes back in the fall, and it happens again, and markets go down another 50%. Like, you have to be able to hold those two ideas in your head at the same time, maybe not as equally plausible, but as possible. And we talk about this a lot with valuations. And we used to say with valuations last year, we do speeches. We say, this is the stock market is trading at 32. What's most likely? Most likely is it drifts back down, mean reverts to around average, in which case you'll get 4% or 1% a year. Could it go back up to 45? Sure. And you have to plan for that scenario. We'd say, how does it get there? How does it get to a 100 P ratio? Maybe Elon Musk invents free energy. It could also go back down to 5, which has happened before, P ratio, in which case stocks decline 80%. What would cause that? Who knows? Could be something we're experiencing. So you have to hold both thoughts in your head and prepare for both outcomes. What's most likely to happen? Something in the middle. So playing blackjack, most likely events are statistical. The outliers always happen. There's the idiot at the end of the table that, hits a 19 and gets a 2. And he says, see, I told you so, or something like that. But unlikely. So you prepare for both to be somewhat anti-fragile. And the way that I do it, and we didn't really touch on it, is the hardest part of the public market stuff is staying the course. So buy and hold investing works great. You have over 100 years of it working great. The problem with buy and hold investing is that, and this is stocks, bonds, real assets, is that all the bad stuff happens at the same time. So you have a bear market, you have a recession, people losing their jobs, their account balances go down. It's all happening at once. So the hardest part with buy and hold is usually during the bear market, people sell on the way down or to the point where they just can't take it anymore, right? But traditionally, if you hold and add over time, it's a great investing strategy. The flip side, which we didn't really talk about, which is half of my investment portfolio, which is larger than any institution in the world that I've ever talked to, is in trend following strategies. And that can mean a lot of different things, but the very basic is you're investing in a market that is going up, you're out when it's going down. You could use something like a 200-day moving average. We have a paper coming out that investing in markets at all-time highs is actually a great idea, or like say percent of all-time highs. The problem with trend following, so you can apply that to an entire portfolio. We wrote an old paper back in 2006 in the Journal of Wealth Management that successfully navigated the global financial crisis. And I didn't think I'd ever see anything like that again in my lifetime. And sure enough, that portfolio, which was so basic, it looked at 200-day or 10-month moving average on updates once a month on stocks, foreign stocks, bonds, REITs, commodities, and it exits each of those when it's in a downtrend. Going into March, it would have been 100% cash and bonds. So who knows how this is going to play out. But the thing with trend following is that it's also hard to follow. It's hard to follow because it goes through long periods of underperformance. The entire 20 teens, anything other than buy and hold U.S. stocks struggled. And there's I can't remember if Warren said it or Charlie said it, but they talk about, the emotions of fear and greed is not what drives markets, but the biggest thing being envy. And so the problem with trend following is that if you're underperforming and chopping along when all your neighbors are making hay in stock markets, you're not going to stick with it. But the beauty of this approach is what we call the Trinity portfolio, which is what I do with all my public assets, put it into one fund. And by the way, listeners, I think this is really important. because a lot of people don't know this, the vast majority of mutual fund managers, depending on the category, it's like 50 to 90% have nothing invested in their own fund, $0. And if you go up to even 100 grand, it's even less. I put all my money into our own funds. We have 11, but half is in buy and hold and half is in trend following. And why does that work for me? Because in a year like 2019, I am so happy to have a big chunk of my money in buy and hold as markets romp, up in the world. In 2020, I'm happy to have a trend following allocation that markets, and depending on the fund you use, we use some of ours, some of other people's, either go to cash and bonds, or they'll straight up short some of these asset classes. And if you look at managed futures, most of those are having a pretty good year. Many of those are up. And so the combination of the two, it's like a yin yang. Thank God we have trend following in 2020, because if it does get worse, if we do have this bear case, hopefully I'm protected. But if markets rip back up, we find some treatments and the bull case happens, and thank God I have the buy and hold side. And this lets me behave. Bogle used to say he put half in cash and half in bonds. He said, because half the time he spent worried he had too much in stocks, and the other time he had worried he had too much in bonds, or too little, vice versa. It's the same thing. So that works for me. It may not work for a lot of people. The one other thing so as far as your question, I answered as an investor, but as a policy question, it's really tough, man. I think a lot of, hopefully this is a short-term thing. I read last night the Imperial College report, and do not read that if you want to go to sleep or not have huge anxiety and depression for the next 6 months. We just don't know. And so, look, I think that is the government's responsibility, and the private sector hopefully can help as much and try to find treatments, but is to backstop those in need when you have something that's totally out of control. It's not to backstop the fucking cruise line, excuse me, but it's to backstop individuals that are, in the restaurant industry, the service industries, the people, the healthcare workers that still have to go to work. God bless them. You and I are lucky enough to be able to do this sort of job remote. How they do that, I don't, whether it's universal basic income, whether it's incentives, I'll leave that to the lawmakers. I don't know the best answer, but there's probably a sensible basic idea that works.
Yeah, I wrote today about the unemployment levels, and I went back and I looked at like Great Depression and kind of really tried to understand the unemployment levels there. And one of the data points that just blew me away was in 1929, right before it started in kind of August 29, unemployment was at 3.1%, right? So very similar to where we are today. And it kind of ramped up over from 29 to 33 up to that 25% number that everyone always kind of, highlights and yells and screams about. But in the second and third year, it was like 8-point-something% and then 15%. And so those are still very big numbers, right? But they're not 25%. And I started doing some back of the envelope math, just seeing the unemployment kind of multiples that we're seeing. So Ohio, Minnesota, New Jersey, et cetera, all reporting, in some cases, 7 to 10x increases on unemployment claims over the last couple of days, beginning of this week. And who knows if that's sustainable? Who knows if that's not just kind of one-time thing or whatever? But when you start to look at this, you're like, look, sitting around a 3.5% unemployment rate, anything above that can bring some pain. And I'm right there with you. I think that like you've got to figure out how do you help these people, especially when you're asking restaurants to shut down, you're asking bars to shut down, et cetera. It's just I hope that we don't kind of lose sight of the small business owner, right, who's not sitting on tons of cash. They're not worried about stock buybacks. They're worried about how do I get to next month and continue to make money for my family or their staff. I've got multiple friends that own restaurants or kind of hospitality type stuff, and they're literally like, look, I have to fire half to all of my staff in order just to continue to not have to go into bankruptcy because my cash flow or revenue went from a lot to zero because I literally am shutting down. And it's just a really kind of crazy time. So I don't think we've ever really seen something like this before.